So, once again, good evening and welcome to the session. So, today we are going to talk about the Chinese markets and the stock market of China, which is broadly represented by major indices. And the session which we have to do today, this was decided a month ago that today we are going to talk about China market outlook. And consequently, today is the day when Hong Kong index has gone up almost by 6.8% in one single day on the news of an extra stimulus being introduced in the Chinese financial system. So, I mean, it's obviously a coincidence that while we are doing uh, a specific market outlook about China, at the same time, today is the day when the Hong Kong index, which is a broader representation of the Chinese economy, it moves 6.8%, and it's a big move. I'm going to show you the chart today that how much it has moved, and then we're going to discuss a little bit about how Chinese markets have performed. First, the big news today, which is coming in live, a lot of Chinese stocks have closed sharply higher after Beijing has firmed the stimulus measures. The property stocks in China have gone up, and a lot of these stocks they extended gains after the state media announced that China's top leaders have affirmed that government's latest effort will be in supporting the economy. And the mainland index of China, which tracks the stock performances, it has continued to go up on the seventh day. It has gone to the highest level in last 4 months, and that is the reason because China's top leaders have held a meeting and they confirmed that government's latest stimulus efforts will be continued. And all the other Asian indices have mostly shown bounce. In fact, South Korea's index have also jumped, but primarily for the reason because the chip maker SK Hynix, which announced it has begun mass production of the world's first 12 layer HBM3 chip, which is used in AI memory applications. So it's a good day for Asian markets. Most of the Asian Pacific markets they went up today, and the leading index was Hong Kong's Hang Seng Index, which is the Hong Kong 50. And the mainland Chinese markets also extended gains towards the close of the session. Chinese and Hong Kong stocks have climbed very high, and this has the primary reason has been the decision which has been taken by the top leaders of China, and they held a meeting and they confirmed that the government officials are going to be supporting the economy. In fact, the Chinese President Xi Jinping led a meeting earlier and talked about the power of ruling the Chinese Communist Party. And today, this is something which is very important. Why? Because um, the central bank itself has announced that there are going to be interest rate cuts, and they have cut interest rates, and they have said that they would continue to extend support to the real estate market, right? And there are a lot of other plans which are coming in. So the Hang Seng Property Development and Management Index has also gone up by 14% on this news. The Hong Kong index itself has gone up almost by 6.8% today, and I think very close to its final hour, it ended around 4%, which is the highest level since May. So this is something which is really important because in last 2 years we have seen the China stocks falling down, and this is the reason behind that China has been on a very different economic cycle if we compare to the rest of the world. Um, while the rest of the world have been into mostly the inflation had gone up, and then the efforts were done to bring down the inflation, China was very close to the deflation. And the reason is, as I said, that China has been in a different economic cycle to the rest of the world. um, Over the last few years, Chinese economy has been under pressure, and that was mostly because of the housing market, the real estate market. which took a downturn, and that was in 2021, 2022. But now, when you come into 2024, there have been some promising signs which have started to emerge. Um, if you see the manufacturing sector, it has outperformed, it has contributed to the economic stability, it has improved the growth outlook. And I'm not just talking about manufacturing in general, but if you see the high end manufacturing, which is electric vehicles or industrial automation or digitalization, and all of this together with supply chains, they are growing really at a faster pace. And with these high value added sectors, this is something which now are having a bigger impact on the macro cycle of China. And I mean, for 2 years, Chinese economy has decelerated. There have been a range of indicators at this point which are looking more mixed, and it looks like that this could be the bottoming out of the Chinese index. Like, it seems like it has bottomed out and it is ready to move higher. But again, there are a lot of factors which we are going to talk about, which might impact. US elections are coming in, and whosoever is going to be the president, it's also going to have a major impact on what happens next. So if if you see the overall state of consumption is still weak, um, and if you talk about the purchasing managers index, which measures the manufacturing, they're still diverging, right? But then if you look into the exports have started to do better. If you talk about housing markets, at this point of time, the policymakers, they're very focused on preventing further slowdown. And while structurally the slower growth in the housing sector is still our base case, if you look at like if you take together, we think that even a marginal improvement in these areas, these are really good news for the rest of the economy. And I think the economic cycle may be at an inflection point. uh, I think we need to look at more and more data to be sure, because today's step of introducing more stimulus, it has come after already when a stimulus was being added, when liquidity was being injected. It's just it was not enough, and that was the reason why more cash is being introduced in the Chinese economy. And I think if that's not enough, maybe more of this will be introduced. So that is the reason why the Hong Kong index today continues to move higher. And um, as I'm getting the opportunity, let me just show you the chart itself today for the Hong Kong index. Just going to share my screen with you, and let me add Hong Kong here, 50, and look at this. So as we speak, already up by 5.3%. And let me show you the big chart, and look at this growth. Look at this growth right now. This is last 10 days. If you see, in a month of September, look at this growth. It's phenomenal. It's almost a V shape, or a very, very steep upside movement. Day one, day two, day three, day four, day on day, we have seen Chinese index. So if you see around 10th of September, 11th of September, it was around 17,000 somewhere Hong Kong dollars. And now look at it has moved so high. Today it is 20,375 or 20,430. 3,000 Hong Kong dollars movement in just a span of 14 to 15 days. And of that entire movement, if I just reduce the duration of my chart, let me show you how Hong Kong index has moved in last 5 to 6 days. Look at this movement. Look at this phenomenal movement. I'm going to further reduce the duration of my chart so you can see that how in every 15 minutes the market moves, especially today. Today is 26th of September. Look at the growth. It has continued to move every 30 minutes. It just continued to bounces back, comes down a bit, and then again finds the support over here, and then bounces back. And look at the resistance over here. Today's movement is around 5.5 to 6%. That's a big movement in an index. If an index is moving around 6% in a day, up or down, that's that's a statement. That means something really positive has happened, and positive has happened, as we said, that the stimulus have been introduced by the Chinese officials, and a lot of stocks have already moved up higher. Even U.S. equities also, they were higher firmly, and S&P 500 is still on the pace for another record high. The investors have reacted to the reports of new financial support from China's flagging economy, and that is the number one reason why even US markets are up today. And China stocks, meanwhile, as we said, are on pace for the best week in a decade, um, because this is something which a recent meeting happened in Politburo, where the Chinese officials vowed to commit to the necessary fiscal spending, which will be required to reach its annual 5% GDP forecast. So this news has lifted the stocks around the Asia region. And if you see, even through the European session, we have seen European indices also have moved all-time high. Even a further boost, I think, has been provided by the report that Saudi Arabia is going to abandon its loosely held target of $100 per barrel in order to win back the market share. So that's again a sign which we have seen here, which is pushing the stocks higher. Uh, we know last 1 week has been very positive for U.S. markets because the Fed chairperson Jerome Powell, he also showed a lot of confidence in the economy, and there was a 50 basis point rate cut, which pushed the U.S. equities higher. So at this point of time, we see major equity indices are moving upward. You talk about Europe or Asia or US, all the stock indices are reaching to the highest. And as we are looking at the screen, let me show you um, last 1 week or 10 days for all the indices. So this one right here, um, month of September here, this is for, look at this is entire September. Look at this shape right here. And this shows the increase in the Hong Kong index. And now let me show you how the US index have moved. So look at US 30 right here. Look at US 30. Let's see. Or in fact, look at S&P 500. Look at the month of September for S&P 500. Right? Look at this increase right here. So markets across the world have shown positive signs after the Fed rate cut happened, and now stimulus in China coming in. So these are the few things which are pushing the equities higher. And it's another news that what is going to happen next. Is this stimulus enough? Because investors have welcomed this unprecedented um, stimulus, which is trying to boost the markets. And I'm sure there are a lot of analysts who still believe that this is something which is a short term welcome to a kind of toolbox, which is promised by Beijing to stabilize the markets and revive the spirit again. But I think the bigger concern is still whether this will be enough to stimulate the Chinese economy or not, because it's $114 billion stimulus, and this is done to boost the stock market. And this is basically will motivate asset managers and insurers and brokers to buy more Chinese stocks and list more companies on the stock. And I think this is for the first time the um, China central bank has innovated and used these types of monetary policy tools to support capital markets. And this is something which is, again, the funds which have been allocated could be doubled or tripled if these schemes work. And a lot of policymakers, they are floating the idea of stock stabilization fund. And again, the idea is that the Chinese stock markets have been in slump for the last 4 years, and there was a lot of lack of confidence in the economy. But now, from this announcement which has happened, if you see, there has been a major increase in the stock indices. And let me just show you a small um, history, that how in 2020 and after 2021 and 2022, look at this period right here. And it's really important to see so that you will get an idea of what's actually going on. Please continue to write if you have any questions. So I'm currently showing you the chart of the Hong Kong index, and the duration which we are looking at right now is from 2023. So I'm going to, let me take you to 2022 as well, and 2021 as well. And look at this consistent fall which has happened. So first was this 2021. Look at this right here. And then you move on to 2022, which was even further decline. If you see, look at this right here, this entire fall right here. And then comes 2023, and look at 2023, which again, if you see, further decline right here. Let me just show you once again. Look at this right here. Look at this big fall which was there in 2024 mid till March. And then look at this. Look at this right here when the channel has broken, and see how the markets have started moving higher. Look at this right bounce here, and again retracing back a bit, and here again slightly higher, and then that's here and continues to go up. So obviously there's a lot of fundamentals involved here. I don't think this channel would have been able to break if the property markets would not improve in China. I don't think if this was such a great increase in the index was possible if there was no stimulus coming in, because they really needed that. And that is the reason why we see today that the Chinese index has moved around 5 to 6% higher. Now, beginning this, let's understand what you're looking at is the growth rate of the real GDP in China, which is from the data which you see is from 2013 to 2023. And if you see the key points on this, the real GDP experienced significant growth between 2030 to 2021. So if you see this chart from 2013 to 2021, before it actually fell down, if you see this recovery right here, so it's been a very positive year. Now, if you see the slowdown which started with 2022, and uh, what we saw in 2022 was again a big drop right here. And you see from 5.2% down to 5, 4.5, 3.7, and even further decline. And if you see, it is expected to continue. But then now with the stimulus coming in and things getting better, maybe, as I said, the 5% annual GDP rate, which is the target of China, maybe this curve moves a little higher. And that is the reason why we need to have a look at it, that how this curve has declined. And now the entire expectation of putting this stimulus is to improve this projection and not remain at 3%, go to at least 5%. And for that, as much fiscal measures are needed, it will be provided. That is what the Chinese officials have vowed upon. The next thing which you see is the overseas China Internet Index fundamentals. That is something which is very important, because we are going to have a look at this and see that how the tech area, especially the internet companies of China, are performing. And I think this is something which is really important, because China, as a manufacturing economy, industrial manufacturing economy, has very closely and fastly moved to service based and tech based economy. So I think that is also something which is changing a lot, and I think this is something which is also a matter of importance, that what we like to see here is that if there is a transformation happening in China, then we should be there to take the opportunity. There's a question right now on the chat. Before I move on to the chat and explain you more about this, any view on USD versus Chinese yuan next 1 year? Will CNH weaken versus USD? See, I can give you a technical perspective to this, because further US dollar weakness appears likely. I mean, um, oversold conditions still suggest that declines could be relatively limited. But in the longer run, I think USD is likely to continue to get weaker. And there are a lot of technical levels to watch in this, because I think a lot of traders are looking at the currency more in a technical way. And there are strong resistance and support. So if I were to give you a very short term view as of now, a lot of people have gone negative on US dollar as we speak. It is likely to trade with a downward bias, I think. And a sharp sell off could occur, because even in US the rate cut cycle now has started. So, and again, it will definitely depend on the US elections, what happens next. So, that is why there is a lot of technical perspective on this. And if we see fundamentally, I think USD CNH is still likely to continue. Sharp declines will be there. And I think the depreciation of the Chinese currency, it's the worst of the China's depression pressure. I think it's probably over, because there is still a lot of geopolitical risk. And if you see, uh, China's inflation now is getting weaker, but Fed rate cut pricing, now that could create a reversal risk, right? So I think the Chinese economic data at this point of time is not really showing any meaningful signs of improvement. Rate cuts have been expected, and rate cuts have happened also. But let's understand this. See, China inflation, it still remains very weak, right? uh, the inflationary pressures are still weaker. Um it does pose a big threat to a downtrend in USD CNH and US bond yields. If I say, they have gone down. Chinese economic data, as I said, it's not showing any meaningful signs of improvement. Rate cuts are expected. If we see from central bank of US in the next 1 year, because we are looking at the next 1 year trend, in next 1 year we might expect at least 125 or 200 basis point of rate cuts. Now, any stabilization or reversal of interest rate differentials, that could deliver a renewed weakening in the yuan. That is the only thing I think which is which can move. And I think if the rate cuts do not happen, or if there is a major interest rate differential, I think that is the one which can make yuan weaker. Otherwise, if you see, I think other Asian currencies, if you look at Australian dollar, they will also follow the same trend. Um, at this point of time, dollar had already moved a lot higher. So I think the major role will be mostly played by the central bank of US. And if rate cuts happen at a faster pace, that should decide more on the USD versus CNH in the next 1 year. Because expectation from China is to further improve and get better. But on the case of US, we might see a weaker dollar in the coming next few months. So that is something what we feel. I think we should completely look at the currency in a shorter term period and not in a very long term. And in a short term, we should abide by the technicals. because fundamentals in both the cases, while China is expected to bring more and more stimulus, they are very smart in. So we have seen that how China has depreciated yuan before to increase the exports, and US has already been aware of this. But now at this point of time, I still feel that with further rate cuts coming in, USD might get weaker against Chinese yuan, and that is the reason why I would suggest that just look at the trend very closely on a short-term basis, more week to week or month on month, rather than taking the next 1 year outlook. Now, as I said, the current chart which you're looking at, the overseas China Internet Index fundamentals. Now, just to highlight the key points over here, this is the Internet Index, which basically shows you that how much China's exposure is to the US stocks. And this particular index is heavily weighted towards communication services and the consumer discretionary sector, which is the luxury sector, a focus on the technology and consumer related companies. This particular index, which you will see, I'll go back to the chart so you can have a proper look at this, is a high PE ratio. And if you see the earnings growth, also 3 to 5 years earnings growth, especially compared to S&P 500, it's very strong. Communication services and consumer discretionary sectors, this dominate the index, which you see. So if you see this particular chart right here and look at these sectors, so I think the most important part of this is the reasoning that why we have seen stronger PE ratios, and we also have to check that why the reliance. So just to show you once again over here, look at this. So just have a look at the key trends which we are looking at this overnight China index. Attractive fundamentals compared to a broader China exposures in US stocks. So the index which you're seeing right now is very dedicated to the internet stocks. And if you see the weighting also in this particular index, it's heavily weighted towards communication services and consumer discretionary sectors. More focus is on tech and consumer related companies, right? This is important. Why? And I'll tell you the reason why. Because if you see, there has been a rapid digitalization and e-commerce growth. China has witnessed a rapid expansion of the internet infrastructure. So there was a question asked. I was doing one of the seminars, and somebody asked a question that should we invest into the industrial sector of China if China is expected to rebound? But the point is that now it has moved towards a more digitized economy and an e-commerce market. And China has, as I said, witnessed a very rapid expansion of the internet infrastructure and e-commerce market. Now, this has created a lot of significant growth opportunities for internet companies. Their valuations and earnings have actually gone better. And as I said, government is supporting, the China government has actively supported the development of the internet sector through a lot of favorable policies, investments, and initiatives. And it's a very good environment for the internet companies to thrive. I think that is the most important reason that why a lot of investors now they're focusing on a ETF called China Internet ETF, which is more focused on the tech and internet companies. And there's a whole index dedicated to it. So, and another reason, again, there's so many reasons, but just to point a few of them out, which I feel innovative and tech advancements. I think a lot of Chinese internet companies, they have been at the forefront of the technological innovation. They're developing new products, they're developing new services, and they're able to cater the growing needs of the consumers. So that is another reason that why there's an internet revolution. From the followers of tech, they have become the leaders. The domestic market, if you see China's vast population and a growing middle class people provide a very massive domestic market for the internet companies, and the demand for their products and services have continued to go higher. Even if you see the expansion globally, there are a lot of Chinese internet companies that are successfully expanding their operations beyond China. I'm sure that recently an issue regarding Temu and Shein, which recently happened, where they might have to pay heavy tariffs, and that has impacted their parent company, and the stock has been impacted also. But that kept aside, again, as I said, that there are again a lot of ifs and buts which are coming in. But to give you a broader perspective of how China has improved in last 2 to 3 years. So as I said, that a lot of these Chinese internet companies, they've successfully expanded their operations beyond China, and they're capturing this market share in other regions and contributing to the growth also. Consumer confidence, which is something really important. It's investors now, they have generally maintained a very high confidence in the long-term growth prospects of Chinese internet companies, and that has led to a higher demand for their stocks. They have drove the valuations up. All of these factors combined, they're creating a very favorable environment for this kind of internet index, which I'm showing it to you. So I think that is the reason why we are currently looking at the internet funds of China. So if you are more doubtful about investing into China and economy as a whole, you should be able to provide a part of your investments to the internet sector of China, which is doing really better and now transforming the entire economy. Now, understanding, we were just talking about the power of e-commerce, the two biggest companies, which is Alibaba and JD.com. This year, the sales festival, which happens across China, we have seen that 6.18 sales festival, it was a success. Brands like Alibaba, 365 brands sold more than 100 million, which is $13 million worth of goods have been sold. 36,000 brands doubled there from last year's festival. Apple, Nike, L'Oreal, Lancome, Adidas, Estee Lauder sold more than $138 million worth of products through Alibaba. During the campaign period, the 88 VIP subscription program enjoyed an increase in the new member of 65% year over year. So, if you see, even Alibaba has rolled out the AI-powered tools for the merchants and shoppers, and shoppers had access to the AI chat bot. Meanwhile, merchants had access to AI-generated advertisements, product staging, analytics, every single thing. So they are integrating AI tools also together. And then Alibaba is one, JD.com is another. 83 brands sold more than $139 million worth of goods. 150,000 merchants increased sales by at least 50% from last year. Transaction volume in the categories of fashion, beauty, and sport brands increased by 100% year over year. Fastest delivery time during the festival was a record 9 minutes. This is really, really important, guys, because as I said, that this is what is shaping up the Chinese economy at the moment. And the current stimulus being introduced. There are a lot of investors who have been away from Chinese markets for a while now, and with good reason, because last 2 to 3 years we saw China falling down. But again, uh, every single economy recovers, and I think this is one of those stories where China is possibly recovering, as I have shown the chart and the graph and what has been happening today itself alone. Now, looking at this, if you are currently looking at the internet names which have higher expected long-term growth rates than other sectors within this index. So just to give you a slight idea, internet names with MSCI China Index have consistently demonstrated the higher expected long-term growth rates, and the consumer and other sectors have experienced more fluctuations in the growth rates as well. Few things which we would want to point it out. There are geopolitical headwinds. Geopolitical tensions still continue to bring a lot of attention on what I'm talking about right now. The tensions between US and China still pose a very significant threat to the global economic development. Increased trade restrictions, fragmentation can lead to substantial economic losses. So recently there was incident where shoppers, the companies like Temu and Shein, they were able to utilize a loophole where they could bring a specific value of products into the United States without paying a certain duty. and they were bringing a lot of business like that without paying import duties. Now, actively, the US officials are working on banning that loophole and restricting it for Temu and Shein to do this without paying any import duty. So that is definitely going to hurt the profits. That is definitely going to hurt the parent company, which is PDD. And if you want, you can go and check the stock as well, that what has happened. Let me check if it is right here. With me here, or okay. So as I said, you can always have a look and see that what happened to that particular stock. And so there are increased trade restrictions. And as I said, if Donald Trump becomes the president again, that could not be good for the trade between US and China. And that is something which one must take into consideration before getting the full view of the Chinese economy. Now, zero sum game geopolitical relationships are often seen as zero sum games where one party's gain is perceived as another's loss. So, that is always something which could be an idea. China and Taiwan also, if we are talking about these kind of tensions, I think China's relationship with the West is one threat, and then China's relationship with Taiwan could be another. And there are again such kind of issues which can hinder the growth. Impact on developing economies, restrictions on economic access to large economies, it can hinder development opportunities for developing countries. And again, need for openness, which means maintaining open markets for China and the rest of the world, is crucial for a global economic growth. Now, that's where the major concerns come, because deglobalization it feels like a new trend. And at this point of time, the kind of relationship China has with the West, that could be a major concern. And depending US elections which are happening now and what the foreign policies are going to be like. So of course we need to be careful in this. That is the reason why. So there are different ways you can invest, right? In case of China, you can invest into a China Internet ETF, which is presentable to you on our platforms as well. That's called Crane Shares China Internet ETF. So which gives you a focus. So the question is, should you forget about the economy as a whole and just focus on the internet companies and buy a fund which allows you to take exposure in the internet companies of China? Second is go long on Hong Kong index. Just buy Hong Kong index and wait till it continues to go up, because as I said, in last um, 1 month or so, it has already moved more than 10%. So is this something which you as an investor would do, that just buy the Hong Kong index and hold on to it? Or there is one more way where we can try to neutralize the impact of volatility of this entire market movement, and try to see that if we can create a strategy around this. And this strategy is called pair trading strategy. And pair trading strategy allows the clients, the investors, to reduce the impact of volatility on your portfolio. So if you just go long on Hong Kong index, tomorrow if something happens, index falls down, and Asian market as a whole could impact this. If you buy the China Internet ETF, tomorrow again, if the growth slows down, you are on a one-sided trade, it can bring your portfolio down. So while you can choose to take either of the risk, it depends. You can also choose to try it out if we can create a pair strategy. Now, how that works, I'll share this strategy with you, and you can definitely have a look. But please make sure that if you're about to implement this strategy, you must be talking to an investment consultant before you do that. And that's really important. Any strategy which you're going to implement live on your live accounts, you must talk to a risk consultant before. These strategies are not risk free, they always contain risk, and the trade may or may not go in your favor. So for that reason, please understand the strategy first before you take that risk on your live accounts. Let me just share the strategy with you so that while I read it, you can read it too. Look at this. So this is called a pair trading strategy, which is between. It's working fine at the moment, I think, because this strategy came out somewhere around when we started talking about it. I think that was around 4th of September. Today is 26th, so I think it's been around 22 days. But then so far the strategy has worked out well, and it continues to move. Um, Long Hong Kong and short Japan. So in this pair trade, you buy the Hong Kong index, but you short the Japanese index. Now, I'm going to give you a fundamental reason first, and then the technical reason. To give you an idea about how a pair trade would actually work, pair trade simply means that you are bringing two instruments here, and you're going to buy one and you're going to short sell another, but with equal value. So if you're buying Hong Kong with $50,000, you short sell Japanese index with $50,000 at the same time. So you enter at the same time, you exit the pair at the same time, and that's how the pair trading works. And pair trading works on the ratios, which means we analyze the fundamentals and then we look at the technicals. So in this case, for example, let's look at the fundamental rationale first. Let's look at the Hong Kong, that why Hong Kong could be a good buy and why Japanese index could be a good sell. So let's look at the Hong Kong part first. And so China's post-COVID economic recovery has been sluggish, limited signs of improvement in 2024. Now that's what was already posted. Manufacturing remains weak. Property market slump is further hindering growth. However, much of this weakness has already been reflected in the market. So that's really important, right? In financial markets, there's a popular saying which says, buy the rumor and sell the news. It means that when we experience weakening of the economy, sluggish economy, limited signs of improvement, the manufacturing becomes weaker, and real estate market slumps. Every investor could see that it's hindering the growth of the country, and you see the stock markets following that. And once the market falls down a lot more, it is said that this weakness has already been priced in. So the last 2.5 years, we saw the impact of the above factors on the Hong Kong index, and we saw that how much it has fallen down. In fact, it fell down almost 50% from its peak of 34 or 35,000 Hong Kong dollars. It fell down all the way to 14. So we saw that decline happening. Now, to stimulate the economy, many economists are calling for more than aggressive government action. So they suggest that People's Bank of China, which is the central bank of China, should lower interest rates and reserve requirements by 0.25%, and increase the liquidity, encourage lending. So this is all is happening as of now, because this strategy was made on 4th of September, and as we see on 26th, stimulus is being introduced. And I think this is what we expected when we were writing this report. So additionally, the government should increase the budget deficit, triple this year's special sovereign bonds to 3 trillion yuan, which is $420 billion, to fund the consumer subsidies and reduce the local government debt. Even Chinese lender may lower the 5-year loan prime rate. So this is important. Why? Because the real estate market has suffered a lot. And in response to that, the Chinese officials are trying to bring the long-term financing rates down. And that should encourage more loans, which could fuel the demand for real estate once again. So that is something which is also very important, because the mortgage cost needs to be at a lower price, so that the mortgage can be motivated, and then the real estate prices can boost up. Meanwhile, Alibaba has secured a shareholder approval to upgrade its Hong Kong listing to primary status. And that's big news also. We just saw that how much impact Alibaba has created in the last sales, and how much money they have earned. Alibaba has secured the shareholder approval, and then a lot of analysts, they anticipate that this is really going to attract a lot of investment from the mainland China, billions of dollars getting into it. And this has also increased the likelihood of Alibaba's inclusion in the Shanghai Hong Kong Stock Exchange Connect program. And that would enable the mainland Chinese investors to directly purchase the company's shares and we are expecting a lot of capital inflow from the Southbound Connect program, and that could be around 12 to 19 billion dollars in the next coming 6 months. That is really going to fuel up the Hong Kong index as well. And if you see, I gave you one fundamental reason, I'm giving you one technical. Look at the triple moving average convergence. And this is recommending a potential upswing, because whenever these crossovers happen, so look at, I'm just going to make it easier for you. These three lines are the moving average lines. Moving average lines tell you the average closing price of the index. So you want to observe the 50-day average closing price, and then 100-day average closing price, and the 200-day average closing price. When you put these three lines on the chart, you see that there's a potential strong support zone at the crossover. So look at these A, B, and C points right here. During those periods, those moving averages were very closely aligned, because so when you see the 50-day average closing uh, joining with 100-day and then combining with 200-day average closing, those are your buying levels, because those are the crossovers which you are looking at. So when they're closely aligned, now if you see the points A, B, and C, during those periods, these moving averages were closely aligned and creating a weaker support base. But if you see the current confluence of these moving averages, it shows a very, very strong support level, especially the index continues to trade above that particular level. So all the triple crossover on the moving averages, this is a technical reason. Again, I gave you one fundamental, I'm giving you one technical, followed by now looking at Japan. Fundamentally, the Bank of Japan has put an end to the negative interest rate policy. Earlier, if you deposit money in any Japanese bank, you would be charged. But now that negative interest rate policy has ended, and the first rate hike in Japan, it happened in March 2024, which improved the short term, which increased the short term in rate from 0 to 0.1%, which was earlier minus 1%. The Bank of Japan took the markets by surprise. It raised the interest rates for the second time to a 15-year high of 0.25% in July, and that happened, and that brought a lot of downside for the US stocks also, because a lot of people apparently who invested in yen realized that now the interest rates are up. So a lot of investors, they liquidated their investments, and that brought the stock markets down. So as I said, that the increasing interest rates sparked such a rapid acceleration in the domestic currency, which was yen, that resulted in an unwinding of the yen carry trade. People started unwinding the yen based trades, and that created a ripple effect across the global markets. Japanese index itself fell down by 12%, and that was worse than the crash of 1987. So, and by the way, a lot of people invested during that crash, and then it bounced back. So this only tells us that when the markets fall down by such a big number, that's the time that when the buyers enter. We'll look into this chart of Japanese index also in some time. Now, inflationary pressures in Japan, it began in 2024, which Japan has been in deflation for a long period of time, and in last 17 years they never experienced inflation, and now they are doing. So they're experiencing inflation, and this is primarily because of the rising energy cost, high prices of durable goods and services. Labor market is tightening up, and the latest data reveals that the inflation has gone up 2.6% year on year, and this was 2.2% in July. So at this point of time, I think the inflation is higher. There is a chance that there is going to be one more rate hike sometime between October and January 2025. And this is possible because they are monitoring the global financial market risk. And if they want to bring inflation down to 2%, they might go for the rate hike as well. Japan's economy, stock markets are very reliant on export. Japan is an export-oriented country. Further aggressive interest rate hike, it could make yen more stronger, which makes Japanese goods less competitive, because a weaker currency support the exports, but a stronger currency, it makes your exports less competitive, and that could negatively impact the profitability of the export-oriented companies. There have been again some political scandals and some sort of backlash over how the Japanese prime minister have spent his money and the cost of living, and it was announced that he would step down in September. The next prime minister will face the challenging task, and they would want to restore the public confidence. And that being said, again, the rising inflation is one of the factors which he really needs to look at. There are geopolitical tensions with China, and again, if Trump victory happens in the elections, that is also something which needs to be looked at. So now, at this point of time, all of these issues could impact Japanese stocks um, for some time. While China continues to improve and bounce back, Japan is facing these issues. That is why a strategy is important where you're buying you're buying Hong Kong and you're short selling Japan, equal value, and you expect this pair to work. So if tomorrow Asian market or Asian equity market falls down, you expect that Japan will fall more than Hong Kong. So your profit in short selling Japan would be higher in the loss which you will make on the Hong Kong index. And if Asian markets improve, then your expectation from this trade is that if Asian markets improve, then Hong Kong is going to go higher and you will make more profit in the buying position than losing on the Japan. So pair trading works as a market neutral strategy. And as we see the fundamentals of both these indices and both these economies, it clearly makes sense for a lot of investors to be long on Japan and long on China and short on Japan. And there are different scenarios again. If you go long and short on both of them with leverage, without leverage, returns could be nine. If I say without leverage, returns could be expected to be around 9 to 10%, while losses can be around 7 to 7.5%. That being said, there is definitely a conversion rate also which you need to check, because while dollar yen is going to be an important factor in the next few months if Japan increases interest rates. Um, Hong Kong dollar and USD is also going to be an important factor when you buy the Hong Kong index. So there is a currency risk definitely in this trade. It could go in your favor, or it could go against you. That being said, it is important that we look at the bigger picture. We do consider the currency risk also in this, and if the movement in the index both ways works in our favor, then the currency risk should be priced in. And another important part is look at the first technical perspective, which was right here, the price ratio of the Hong Kong index versus the Japan. Now, this is called looking at the price ratios. And as you see, price ratio simply means that you divide Hong Kong prices by Japan. And whatever number you get, you plot it on a chart and see this trend since 1995. The current ratio which you see between Hong Kong and Japan, that ratio was seen in 1995, almost 25 years ago, and now it is at that lowest. So that gives a very good technical entry point, that in case if you're expecting ratio to go up, which means we are expecting the numerator, which is Hong Kong, to go higher, or the denominator, which is Japan, to go lower. And that's why another technical reason that why we are putting this trade right there. That being said, you can definitely do this trade in your demo accounts to see the how it works. I'm going to share the screen with you and exactly tell you that how you can execute this trade, and you can take a demo account and you can try it out. If it works out for you very well, you will know one more strategy how you can invest in financial markets, because pair trading is not just between Hong Kong and Japan. It can be done between so many other products. There is one more strategy before I move on to the live platform and show you how to do this. There is one more way that you can take advantage of the Hong Kong movement, and that is called, if you are looking for a short term movement, you can do this through something called a BTST strategy. And a BTST strategy is simply what we call it as buy today, sell tomorrow. And I'll show you how this buy today, sell tomorrow works. And this is another strategy which a lot of day traders are employing currently. And why not? I mean, at some point of time, we need to find out new ideas of how these kind of strategies are to be done. And when I'll show you that how easy it is to do this strategy, you will get an idea that okay, this is something which definitely can be done. So just give me a moment before I open this. Perfect. So just going to share this with you. Right. Now let me close this and go here. So exploring the Hang Seng Index, this is something which we came earlier. But the idea of the BTST and STBT is very simple. Buy today, sell tomorrow, or sell today, buy tomorrow. The concept is simple. It is prepared to take the short-term advantage of the price movements of the index. This is basically for the day traders who like to trade daily in Hong Kong index. And the concept is very simple. When I say BTST, that means buy today, sell tomorrow. Hong Kong index is one of those index which could open at a gap, sometimes at a higher gap, sometimes at a lower gap. And the concept of this strategy is very simple, that you monitor the trend of Hong Kong index in these three sessions. But the most important session is the London session. If you find that London session, which is between 1 p.m. to 5 p.m., Hong Kong prices have ended positive, you buy Hong Kong index by the end of the day, which is 11 p.m., and you sell it 5:15 in the morning when the market opens. This is what BTST is. STBT is just opposite. If you see that 1 to 5 p.m. Hong Kong prices ended negative, you short sell by the end of the day 11 p.m. and you buy it back in the morning 5:15. This is called BTST. Around 8-10 months of BTST or STBTs both were done, and around 15 to 16% return was generated. But that being said, the hit ratio of this strategy is around 63%. So, as I said, these are not risk-free strategies. Of course, there is risk, but isn't trading is all about probabilities. So we need to find out these probabilities and need to see that how it all works. So just to give you an idea, how this strategy is going to be pulled out in a live account. So I'm going to now take you to the live platform, and I'm going to do both the trades and show you that how you can actually take both the strategies in this. So one is the Hong Kong and Japan pair. So first thing you need to do in your watch list, I've already added Hong Kong, and I'm going to add Japan, 225 right here. So this is in yen and this is in yuan. So I open both. This is Hong Kong index, as you see, continues to go up. And then this is Japan, which is also up by 2.8% today. Now the strategy is very simple. You buy Hong Kong, you short sell Japan. So if you see even today, Hong Kong is up by 6%, Japan is up by 2.8%, which means if you had bought Hong Kong yesterday and short sell Japan yesterday, today you would make 6% in Hong Kong, you lose 2.7% in Japan. So rough and rough, you would still make 3.5% on your trade. And that is what this strategy is all about. And how do you take this trade? You're buying Hong Kong, so just put an equivalent dollar amount, say $50,000 here, and your units will be calculated. So let's say around 18 units, which is around 47,500. We'll try to take similar amount here in Japanese yen, 47,000 right here. And this is in dollar terms. So I buy Hong Kong, confirm, place order, and I short sell Japan, which means I'm short selling Japanese index, and this is done. Now, if I were to see my trades right here, let me close one trade. This is what the strategy looks like. You are bought on Hong Kong, you are short selling Japan. And as I said, if you had done this yesterday itself, today Japan is up by 2.8%, Hong Kong is up by 6%. So because Japan went up, you are on a short sell, you lose 2.8%. But because you are buy on Hong Kong, Hong Kong went up by 6%. So you are making money, net profit on Hong Kong and Japan. This is the pair trading strategy. This is how a pair trading strategy works. Will this be the same tomorrow? Not necessarily, but that's the idea of doing a pair, that one of the leg in the pair most likely will be in a loss, but your expectation is the other leg would cover that loss and be in the profit. Sometimes both the legs could actually be in profit. Japan could actually go down and Hong Kong could actually go up, and that divergence can make money for you. But otherwise, it's a good strategy to neutralize the impact of volatility on your portfolio, and you can see this how easy it is. Now, this is one strategy. Second is the BTST or the STBT strategy. How this works, I'm looking at the Hong Kong index right now. First, I change the duration of my chart from 1 day to 4 hours. Now I want to see that London session 1 to 5 p.m. that whether Hong Kong ended positive or not. So if you see this right now, we're looking at 4 hours. So right now, this was 9 o'clock onwards. This was 1 o'clock onwards. So if you see 1 to 5 candle, this ended green, which means by 11 p.m., I should buy Hong Kong index and close this trade morning 5:15. I'll just take you through at the previous historic numbers. This was the candle which was formed one between 1 to 5. It was green. And then looking at this candle, by the end, you should have bought Hong Kong index. But next day, if you see at 5 a.m., it went down. It opened, but it went down. Now you see the red candle right now. But if you see this very closely, while Hong Kong index closed at 19,729, and this is where you should have bought it, the next day opening was at 19,613, right? So you normally close it, you will book a loss here. If you go slightly before that, a few days ago, you would do the same thing. 1 to 5, it is green, and then you buy it around 11 p.m. and next morning, if you see, the candle is green. So the concept is that you always buy if the 1 to 5 p.m. candle is green. So you buy at the end of the day 11 p.m. and you sell it in the morning 5:15. If it's a profit, it's a profit. If it's a loss, it's a loss. 63% chance probability that it might end up in profit. Remaining percentage, it might end up in a loss. If you see 1 to 5 p.m. candle is red, you short sell by the end of the night, 11 p.m., and in the morning you buy and you expect that the Hong Kong would have fallen down. This is called a BTST strategy or a STBT strategy. Buy today, sell tomorrow, or sell today, buy tomorrow. This is done on Hong Kong index. Why? Because Hong Kong index has the tendency to open in gaps, and you can take advantage of these gaps once the market opens. So you must close your position once it opens, because the gap which goes up or down, sometimes this gap gets filled. So if there's a gap up opening and you're making money, you close your trade because that gap could be filled and the Hong Kong index might come down. So guys, this is something which I wanted to discuss today, and I'm glad that we are able to do these two strategies and discuss about the Chinese stock markets and go through the trade trends and the reasons that why the markets fell and why it is expected to recover, and understand a brief strategy about going long on China and short on Japan, and understand how these pair trades work. As I've said, it's a very limited time, so obviously I'm sure there are a few concepts which you may want to give more clarity, or you will need more clarity on. And for that reason, after every session, I'm always available for a one-on-one session with all of you. So you can always register, you can talk to your relationship managers, and you can always register for a one-on-one session, and we can discuss this at length. And these sessions are definitely, as I've said, these sessions are free of cost, And this is something which we do to keep our people aware, keep the potential investors aware, and make them independent so that they can take their investment decisions in the future. And as I said, that whatever it takes, we are hell-bent on giving you this information and more investment opportunities which comes across in this world of finance. So thank you so much for joining this. And under this month of September, this was my third last webinar. We have done a webinar every single night in this month, and today was one of those sessions which was very important given how the Hong Kong markets have moved up. So the opportunity could not come at the better time while the markets are on a turnaround. Tomorrow we are going to talk about uh, uh, asset allocation, and then we'll end this on Monday with corporate earnings and how to trade during the earnings. There's a question here that if we start, can we get guidance with your help? So we are investment consultants, so you can definitely start, and we'll definitely provide you investment consultants. And before that, there will be a training also. If you require, we can conduct training sessions for you and make sure that you understand the risks and the rewards. I mean, it's definitely your money, so it's important that you understand all the aspects of this market. Definitely, Century as investment consultants, it's our primary job to not only just teach you but also provide you that extended support which can help you to invest in financial markets and be aware of any upcoming opportunities. So that's definitely we can provide. Right. So thank you so much for that question. And if you have any further doubts, as I said, that please book a one-on-one session, and I'll be more than happy to sit with each one of you and discuss this at length. And this is something which I really love to um, uh, make sure that everybody understands whichever session I'm doing. So once again, thank you so much for your time. I'm sure 7 to 8 p.m. is that time which you rather spend with your families rather than looking at my face. So if you're doing that, I want to make sure that these sessions are worth it for you. So once again, thank you so much. I will come once again tomorrow, 7 to 8 p.m. Same time, and with a different topic. So if you have any questions about today's session, do write it down, and you can ask me tomorrow. I'll definitely be available, and we can answer some questions together. That being said, thank you so much. You have a great night. Trade safe, be safe, and I'll see you tomorrow. You have a great night, guys. My name is Yogesh. And if you like the session, please go on Google reviews and under Century Financial, and let us know how did we do. And really helps us to continue this, um, continue these wonderful sessions, and provide you more and more information. So thank you so much.